You did everything right. You saved, you earned more as the years went on, and now you're approaching retirement feeling cautiously optimistic. Then you open your Medicare bill, and it's nothing like what you expected. Most people assume Medicare Part B costs everyone the same flat monthly premium. The data tells a different story. According to the Centers for Medicare and Medicaid Services, higher-income retirees in 2025 pay as much as $628.90 per month for Part B alone, more than 4 times the standard $185 premium. That's over $10,000 a year per person. The mechanism behind that number is called IRMAA. Most people have never heard of it until it's too late. By the end of this video, you'll know exactly what IRMAA is, who it hits, when it hits, and, most importantly, what moves are on the table to reduce it. What IRMAA actually is. IRMAA stands for Income-Related Monthly Adjustment Amount. That's a bureaucratic mouthful, so here's the plain version. It's a surcharge the federal government adds to your Medicare Part B and Part D premiums if your income exceeds a certain threshold. The standard 2025 Part B premium is $185 per month, according to CMS. That's what most enrollees pay. But once your modified adjusted gross income crosses $106,000 as a single filer, or $212,000 as a married couple filing jointly, IRMAA kicks in. And it doesn't ease in gently. It comes in tiers, and each tier adds a significant chunk of money to your monthly bill. It's worth pausing on what modified adjusted gross income means here, because CMS uses a specific version. They use your MAGI from your federal tax return, which includes wages, self-employment income, capital gains, dividends, taxable Social Security benefits, and, critically, Roth conversions. If you did a large Roth conversion last year, that conversion counts as income for IRMAA purposes. The right take here: IRMAA is not a penalty, it's a policy design, but not knowing about it is expensive. The first step is understanding the brackets. The 2025 IRMAA brackets explained. Let me walk you through the actual 2025 tiers, because the numbers are the story here. For a single filer, if your MAGI was $106,000 or below, you pay the standard $185 per month for Part B. Once you cross $106,000, even by $1, you jump to $259 per month. That first tier alone adds $888 per year. The brackets continue upward, from $106,001 to $133,000. The premium is $259. From $133,001 to $167,000. It's $333. From $167,001 to $200,000, it's $406.90. From $200,001 to $500,000, it's $480.90. And above $500,000, the top tier, you pay $628.90 per month. For married couples filing jointly, the thresholds are roughly doubled. The bottom IRMAA tier starts at $212,001, topping out at $628.90 per month per person, above $750,000 in joint MAGI. Those figures come directly from CMS for 2025. Now here's the piece that stings. Your filing status matters enormously. A married couple filing separately faces much harsher thresholds, essentially the same dollar cutoffs as a single filer, despite combining 2 incomes. Filing separately to reduce IRMAA almost never works and often backfires. That's not a consideration. That's the rule. IRMAA also applies to Part D prescription drug coverage. The 2025 Part D surcharges range from $13.70 to $85.80 per month, depending on your tier, on top of whatever your plan's base premium already is. If both you and your spouse are enrolled, those surcharges double. The 2-year look-back. Why past income haunts you. Here's the part that catches people completely off guard. Social Security administers IRMAA on behalf of CMS, and they use your tax return from 2 years prior to determine your surcharge. In 2025, Medicare is looking at your 2023 tax return. Not 2024, not 2025. 2 years back. That means if you had an unusually high income year in 2023, a business sale, a large Roth conversion, a severance package, a capital gain from selling a home, your Medicare premiums in 2025 are higher because of it, even if your income has since dropped to zero in retirement. The Social Security Administration has confirmed this 2-year look-back in its official IRMAA documentation. It's not a quirk, it's the design. And it means retirees can face elevated IRMAA surcharges in the first year or two of retirement simply because of what they earned in their final working years. I focus on Social Security and retirement decisions for the 50-plus crowd, and this is one of the most consistent surprises I see. People who retired at 63 with no income in retirement are still paying IRMAA because of a Roth conversion they did at 61. The good news, there is a formal appeal process. If your income is dropped because of a qualifying life event, retirement, divorce, death of a spouse, loss of income-producing property, you can file Form SSA 44 with Social Security and ask them to use a more recent tax year. That's not a loophole. It's a legitimate, documented process that CMS explicitly supports. If your income dropped significantly at retirement, file that form. Strategies that can reduce your IRMAA exposure. This is where I'll be direct. There are real, legal, and well-documented strategies that can reduce or avoid IRMAA. None of them are magic. All of them require planning before the income event happens, not after. The first and most powerful lever is Roth conversion timing. Roth conversions raise your magi in the year you do them. Done strategically, in years when your income is low, before Medicare at 65, and in amounts that keep you below IRMAA thresholds. Roth conversions can actually reduce your long-term IRMAA exposure by shrinking future required minimum distributions. Vanguard research has shown that retirees who manage RMDs poorly can face bracket creep that pushes them into IRMAA tiers they otherwise wouldn't hit. The right move is to run your Roth conversion math specifically against the IRMAA brackets, not just your income tax brackets. The second lever is qualified charitable distributions. If you're 70.5 or older and have an IRA, you can direct up to $108,000 per year in 2025 directly to charity as a QCD. That distribution doesn't show up in your magi. It satisfies your required minimum distribution without inflating the income number CMS sees. According to the IRS, QCDs must go directly from the IRA to a qualifying charity. You can't take the money yourself and then donate it. The income exclusion only works if the transfer is direct. The third lever is the SSA 44 appeal I mentioned. File it if your income has dropped due to a qualifying life event. Social Security is required to consider it. This isn't aggressive tax planning. It's using the system the way it was designed to be used. A fourth option that depends heavily on your individual situation: capital gain harvesting timing. If you're planning to sell appreciated assets, the year you do it matters. A large gain in a single year can push you into a higher IRMAA tier. Spreading gains across multiple tax years, when possible, can keep you below a threshold. Your filing status and other income sources will change the math here. So this one warrants a conversation with a fiduciary who knows your full picture. The data is clear on one thing. The retirees who avoid IRMAA surprises aren't necessarily the ones with the lowest incomes. They're the ones who planned their income distribution deliberately, 2 to 5 years before Medicare enrollment. What to do right now? If you're between 55 and 63, this is your planning window. You have time to restructure. Here's what I'd do in your position. Pull your last 2 years of tax returns and find your MAGI number on each. Compare it to the 2025 IRMAA brackets. If you're already above $106,000 as a single filer or $212,000 as a married couple, start mapping out what income you expect in the years before you turn 65, because those are the years Medicare will be measuring. If you're already on Medicare and you just received an IRMAA surcharge letter, check whether your income has dropped since the year they're basing it on. If it has, and if the drop was due to a qualifying event, file the SSA 44 immediately. According to the SSA, you can request a new initial determination at any time. There is no strict deadline tied to the IRMAA notice, and if you're planning a large Roth conversion, which for the right person in the right income year is absolutely worth doing, run that conversion amount against the IRMAA thresholds before you pull the trigger. Crossing a tier by $2,000 in extra conversion could cost you $888 or more in Medicare premiums the following 2 years. The math on that is usually unfavorable. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this gave you a clearer picture of what IRMAA is and how it works, consider subscribing to Money After 50. We cover Social Security, Medicare, and retirement income strategies for people who are building financial security in the second half of life. Next week, we're covering the 2026 catch-up contribution limits, the exact dollar amounts, and the updated rules on who qualifies, including the new higher limits for people aged 60 to 63. You don't want to miss that one. And if there's a specific Medicare, Social Security, or retirement income question you've been sitting on, drop it in the comments. I read them, and I build upcoming videos around what this community actually needs to know.